If we want to safely identify high probability setups, first we need to make sure we understand the direction of the market and the bias that is in the market being present. We can see that the structure is a trading range because price is swinging up and down through this 21 bar exponential moving average, and this is an indecision in the market. Now, even though we are in a trading range, we need to identify proper channels because we want to follow the trendline rule, which says after break of the trend line, prices will attempt to create new extreme, and after new extreme is formed, there is no longer continuation of the channel and price may reverse or correct. And this is important to understand. So when we are looking at the trading range, we're going to start with the most recent bearish downtrend. What we can do, we can identify the shortened trend line like this, but we can see that the price after break keeps pushing lower and keeps pushing lower, and there's probably a little bit wider pattern. So we're going to use the swing, the wick at the very top, connected with the first two swings, and we're going to find this channel right here. You guys can see that there is a break of the channel and new extreme form. Now there is a second option how we can draw the channel. We can draw the channel a little bit wider, like this, a little bit flatter, and this fits really well. But is this correct? Well, this is not correct because this is too flat and too wide, and you would neglect the break of a trend line and new extreme, because in trading ranges which are small and there are a few bars being present, because this is very low volume trading range, you're always better off sticking to tighter trend lines so you can see the break and see the new extreme, so you're not tempting to going short once the downtrend already played out. So on the balance of probabilities, you're better off sticking to the tighter channels. Now we can see that the price created a break new extreme and consolidated according to perfect price action, and since we are located at the very bottom, we expect for price go to the very top, because this is the goal, this is the target in a healthy trading range, and especially after price created a failed breakout, which can a lot of times generate strong momentum in the opposite direction, we expect for price to continue rolling up higher. We can see that there is a bullish trend working higher, which had a little overshoot, which leads to a break of the trend line or straight up reversal a lot of times. We can see that there is a downtrend working lower. Now we need to draw these trend lines, these channels, even for the micro corrections as well, because the trend line rules apply the same way, not just for bigger patterns, not just for big trend lines, it's even for the tiny ones. Because we can see that we have an uptrend working higher and we have a close outside of this uptrend. So we expect for price to create new extreme, but at the same time we have this downtrend working lower. So once this downtrend is being present, we cannot go long just yet. We need to let the price correct and finish this correction. There was a break and a new extreme form. Now this indicates that the downtrend is over. Can we go long though? We cannot buy the market just yet, even though we're expecting for price to push higher to create new extreme, because we are below exponential moving average. Now this will serve as a point which will later set up the trend line, but we don't know yet. We're just playing the trading range, and the market created a strong move up. And this is already a little bit suspicious because this is already way too strong of a move at the very late part of the trend. So once we see such a strong push up like this, and we came from the failed breakout, there is quite some strong bullish momentum. So even though price broke above the resistance, and most breakouts of trading ranges will fail, this is not the best failed breakout just yet after such a strong rally up. Even though it would have worked, I prefer to wait a little bit, because you never know when you're going to make slightly few more pushes higher. Now once the market is pushing lower, it's pulling back into trading range. You're thinking that you're most likely going to play the trading range rule. You're going to get below EMA and you're going to get the reversal pattern, failed second entry long, because market likes to move in pairs of twos, and as two-legged pullback against the trend is going to be a high probability setup. Because trend right now is bearish. We're pushing back below EMA because the short-term uptrend played out. But just like here, we drew first this short-term uptrend, and we can see that the price kept eventually pushing lower and lower. We can see that we have a break and new high, but price is failing to push it below EMA, and it keeps pushing higher and higher. And this was extremely important, because if this is a truly a trading range, this failed breakout needs to generate strong momentum, and we need to push below EMA to get failed second entry long and push all the way down. The fact that price keeps creating these higher lows that keep not even reaching the midline is already indicating strong bullish momentum and potential bullish imbalance. And this is where we are going to draw a trend line using first couple of swings, and this third swing confirmed it. Now, so right now this is the bullish uptrend that is working higher, and we have a push up higher, and exponential moving average keeps holding price. So this gives you more clues that this uptrend is nice. This is the lowest low of this move down, and we have a higher low entry. We don't have a failed second entry short. Technically, it's all hidden. This is hidden entry. So technically, there's only first tick the trigger below this bar lows. So this is a high-low confirmation setup of the key entry point, and this is first decent high probability setup for today after market open. Nice bullish bar. EMA keeps holding price. You're very close to trendline being holding price, and you can see that the price is creating series of higher highs, higher lows. You can see how trendline is nicely holding at the top and at the bottom. As price push higher and corrected, there's the shortened downtrend, just like the downtrend was drawn here and just like the downtrend drawn was here. You're drawing these downtrends to stay on the right side of the market, and you want to time the market with these shortened trend lines. After you see break of this trend line and the new extreme form, that's how we know that the downtrend is no longer in play, and we expect for price to continue in the previous trend's direction. So the sentiment of the market is still bullish. We located the trend line, and this is a new high, first entry long, pullback, second entry long. This is the two-legged pullback with the overall direction of a trend. And you guys can see we are breaking out of this trading range slowly but surely. We keep making series of higher highs and higher lows, and the trend line, this key entry point, keeps holding price. This is now fourth confirmation of this key entry point, even fifth, and this is how you know this key entry point is valid. And more, you got confluence of the key entry point and the exponential moving average. So you have two key entry points that are holding price. You have a second entry long, nice bullish bar. This happened so quickly, so you probably wouldn't have even had a chance to get in, because I remember watching this. There was a bar closing below this bar that was really bearish, and at the very last second, it instantly reversed and then continued pushing higher. So this was an extremely quick trade, but this is a two-legged pullback with the direction of a trend and the simple price action. You can have two easy trades to start out the day and market continue pushing higher. Now you guys can see I located the resistance right here. How did I came to conclusion that there might be a resistance right here? Well, you're going to draw the measured move from the initial trading range. You're going to copy it and put it at the top, and there is a resistance to be found which came into play later on. So you can use measured moves not just for the legs they are forming with the direction of a trend. You can use them even to locate the trading range and the possibility of another key level and another target being formed. So this is how price action works. Market keeps pushing higher, and market have a little spike and a channel forming lower, and we broke this channel. But we came from this measured move, so no surprise the price is strongly reversing down like that. Now there was a high-low setup which was extremely tempting. I almost took this trade, but you guys can see downtrend needs a new low, and we have a two dojis that stalled and didn't indicate any clear direction. And this was already a good indication that there is something off here. Market, if you have one doji that is okay, that will trigger the first entry short. But if there is another doji bar that didn't manage to create a high low, and then the high low is a third entry, if you combine it with the fact that you need a new low for the downtrend, this is not the great entry. And then you have a failed second entry short. Even though this would have worked, by that time EMA is completely flat in the middle of these bars. This is a congestion. This is a no trade zone. You can get chopped in this congestion. A lot of stems, so this is no good entry as well. Market broke higher eventually and then continue pushing lower. So we have first leg pullback, second leg down. So this is a two-legged pullback down. Now once we see a two-legged pullback down, we expect this downtrend correction to be over, and we expect for push above EMA. But what happened here is the market stalled and EMA kept rejecting price strongly. We have a new low form, first entry short, pullback higher, and price is struggling to push higher so many times, and a second entry short. In fact, it first triggered higher and instantly reversed down, even more indicating bearish momentum. So this is a high probability setup because it's a second entry short, and not even that, this is a new high, first entry long, pullback, second entry long. So these are two setups in one, and EMA keeps holding price. And when you see such a strong momentum below EMA, this is how you know that you can make a quick, easy scalp. So this was a great trade. Market created a quick, easy scalp and then eventually reversed. Once the market is reversing and this downtrend played out, you guys can see market form micro double bottom. You reset the count here because this is the lowest point, and you have first entry short, pullback, second entry short failure. Now take a look. You traded up into the structure. into what looks like a trading range. And even there's a trend line that can be found from the early swings like this. I didn't use this trend line too much. I treated it as a price push higher, consolidated, and I was playing the bullish imbalance. But you guys can see, if you use the first few swings at the very bottom, you can start to locate the trend line where it's most likely going to get confirmation. So this would add even more strength to this failed second entry short. So the downtrend played out with 2 legs down. This is the last push that created the scalp, and with such a strong push above EMA confirming the bullish momentum, you're now looking for price to resume the uptrend and to create new extreme for this initial trend. So the way you trade up into a trading range, you're most likely going to break in the direction you trade into the trading range. So now that you let the correction play out and you know that the bears are no longer in control, push above EMA is confirming the bullish momentum, and the way how we determine it is safe to buy is to get a failed second entry short reversal pattern. EMA keeps holding price, trend line keeps holding price, so this would be a high probability setup. Notice I'm only marking variation of second entries of two-legged pullbacks or higher lows or even failed breakouts eventually. These are the high probability setups. You're not interested in chasing the market on a bunch of first entries at undesirable locations, or you wait for price to come to your key entry points that you predetermine and take the two-legged pullback. That's the high probability setup, and high probability setups are rare. Once you take one high probability setup, there most likely not going to be another high probability setups for at least a couple of minutes, 10, 20 minutes, depending on how the market is slow. If the market is really slow, you may wait 30 minutes for high probability setups to appear. Market radiator break, first leg to a new extreme, pullback, second leg to a new extreme, double top, strong bearish rejection. So you keep drawing the short and downtrends. There's the break, new extreme formed, another leg, and another new extreme formed. When I was watching this and I'm seeing this double top, even though we are still treating the bullish imbalance, since I see such a strong bearish rejection, I wanted to go short here on a failed second entry short, but I ended up not taking that entry. This entry still would have worked because you keep your stop loss one tick above this signal bar to help you using price action structure to help you protect the stop. I didn't enter because the price was already way too stacked by then, and you have a break at a new low, so you really want to see a good momentum because you're not supposed to be pushing lower. But you guys can see there was additional leg down, which confirmed the trend line, confirmed the bullish imbalance, and price continued pushing higher. Another story, triple top, strong push below EMA. Now this was the trade that I took. Since I already mentioned I wasn't really playing this trend line, but I was aware of this trend line and I thought there's enough room for price to create a quick scalp to this trend line. We have a new high form, first entry long, pullback, second entry long, and take a look how strong this bearish leg down is. Now, since you came from the triple top, it's such a strong bearish rejection, you know that a lot of traders are going to get probably trapped on a second entry long directly into this key level. So for that reason, I was looking at this as a failed second entry long reversal pattern, big bearish bar close below EMA, but it is not so close to the EMA, and we have 2 bars with stims, 2 bars that are doji like. I just went short a little bit early. All I saw just getting stopped out and the market eventually creating the second leg where I thought I was gonna create a quick easy scalp, but you guys can see perfect measure leg down. Unfortunately, I ended a little bit too early, but that sometimes happens, just a little fake out trap. They will just stop you out and then will eventually push it lower where exactly you thought it was gonna go. Now, since this downtrend played out with the break and new extreme, you can see that the bullish imbalance is being present because we cannot push it lower. We still are working higher, and these lows are being higher and higher. So once the downtrend played out with the break and new extreme, the same thing you're expecting right here is as you did expect right here. After two-legged correction played out, you're looking for failed second entry short above EMA. Two-legged correction played out, first entry short, little pullback, second entry short, failure. Now there's a first entry short below this bearish bar, and we can treat it as this inside bar created a second entry short. Even though we didn't trigger above here, above this bar right here, the way this inside bar formed, we can treat it as a micro two-legged pullback, and with it tick lower, instantly reverse up, indicating this is going to be a trap. Close above EMA, big bullish bar, great failed second entry short above EMA, and price continue pushing higher. Once you see price pushing higher like this, now it's obvious that the price is way too bullish. As the price keeps pushing higher, there's a new high form, first entry long pullback, a second entry long, but it triggered above bearish bar. The next bar was nice bullish, so this can be marked, you know what, I will mark it as a slightly aggressive entry. I feel it is a little bit too early. But once you have a new low, first entry short pullback, second entry short failure, and you know a lot of people who are trying to pick the top are going to get trapped because they're trying to pick top. Once the market is creating series of higher highs and higher lows, they're probably only trading based on the candlestick patterns on the signal bars. They see reversal bar, they see a big bearish momentum, but they don't understand that right now the structure is bullish and you cannot just close your eyes and take the simple candlestick pattern. You need to rely on the context. Candlestick patterns without context are nothing. The context always overrides the signal bar. So it doesn't matter how good the signal bar looks, you cannot short the market once it's creating series of higher highs and higher lows and the trend is so strong. Now market is continuing higher. New high, first entry long, second entry long, but the downtrend is in play. This is a bearish bar, no clean entry, new high, first entry long, second entry long. But you're already way too close to these highs. But take a look how little room you have into these highs. Not really a fan of this. This can happen, this can reverse on you. Now you finally have a correction. You have a two-legged correction, first leg, pullback, second leg, and now you see what the price is going to do. Because you're not trying to jump the gun, you just follow the price action, and once price push strongly above EMA, indicated strong bullish momentum, this is how you know that the uptrend is resuming and you can wait for high probability setups to appear. First entry short, second entry short failure, second entry short against the trend. If it's going to fail, that's a high probability setup. Now this second entry short created a scalp, but that's okay. We still treat it as a failure when the first bar appears in the opposite direction. Since the trend right now, the micro trend is down, the first bar in the opposite direction is a bullish bar. So we can still treat it as a failed second entry short because people are trying to reverse the market instantly, but the key entry point keeps holding price. This trend line right now is being present and it keeps holding price. And then we have a last first entry long, second entry long that is once again quite close to these highs. You're going long at the directly highs of the day, but since this trend line is holding, EMA keeps holding price. This is a second entry long, and now the market is way too close to the close. Overshoot leads to breakout trend line or straight up reversal, but since the market is so strong, you're only probably going to get break of the trend line. Make sure to study your trades during the weekend so you'll learn from your mistakes, so you'll reinforce the good habits, so you'll really study even the winning trades, because just because you can get sometimes lucky, that doesn't mean that the trade you took was a good high probability setup. But make sure to study your chart at the end of the day so you can speed up the process of understanding how price action moves. So enjoy the weekend.